Good afternoon, everybody. This is Mike Fields. Everybody's on mute right now, but I'm going to open up a few microphones and check and make sure the audio is working. Anna Brooks, looks like you're using the voice over IP. Can you hear me okay? Or Arno, do you have a microphone configured? Can you hear me okay? Maybe they don't. We'll find somebody here. Bob Hendrick, can you hear me?
Yes.
Yes,
Okay,
I can
great.
as well. Sorry now.
All right. I'm gonna keep everybody muted. I'm gonna find somebody that's using the telephone here, the old school technology. Jim Cole, you're on the phone. Can you hear me okay?
Yeah, I can hear you on the phone.
Okay, great. Thanks. All right, so it looks like the audio is working okay. It is a little bit afternoon on the east, so we're going to go ahead and get started. Everybody's microphone is muted right now. If you have questions along the way, I want to encourage you to answer them or to ask them. You'll find in your GoToWebinar dashboard there's a question section. So just type your questions in there and hit send, and I'll see them and I'll try to keep them monitored. If they're kind of a timely thing, I'll ask the question when you ask it. If not, I'll just kind of wait till the end and ask Jim all the questions then. If your question's kind of complicated, I'll open your microphone and let you discuss it and ask it in greater detail. So we're going to go ahead and get started. I won't waste a lot of time introducing Jim. Jim Swan, I've known for, a couple of years now, Jim. We've been working together on a deal, and I've learned an awful lot about something I knew nothing about after 30-odd years in commercial real estate. Jim was originally intended to be a speaker at our convention in San Antonio, but technical, mechanical problems with the airplane and hours on the tarmac and back and forth kept him from making it. But he's been kind enough to agree to do it in a webinar format. So Jim, with that, I'll introduce you, and everyone can see your screen now, and they'll be able to hear you as well.
Great. Thank you, Mike, and thank you all for joining this presentation. I'm really sorry I didn't get to meet you all in San Antonio. I would have enjoyed that, but like Mike said, it was just I had a lot of airplane problems that day and traveling. I am with Stifel Nicholas, a municipal bond broker-dealer, or actually just a broker-dealer. They deal in all stocks, bonds, and everything else that you would expect from Wall Street. They are headquartered out of St. Louis. They were organized back in the late 1800s, and they are one of the largest non-bank broker-dealers out there. As you probably all recall, back in 2008, Goldman Sachs and Morgan Stanley converted to a bank model, and so we're one of the largest non-bank broker-dealers out there. I am an investment banker, and the area that I specialize in is project finance. And today, Mike has asked me to talk to you guys about using tax-exempt bonds as a funding source for the acquisition and development of multifamily real estate. So I'm going to begin. Again, this presentation was put together for your presentation in San Antonio, so the date's off, but the material is timeless. Starting off, municipal bonds. Municipal bonds are bonds that are issued by government and government entities. There are generally two types of municipal bonds. There are general obligation bonds and there are revenue bonds. General obligation bonds are bonds that are issued, for example, by the city of San Antonio, and they're backed by the full faith and credit of the municipality. And then there are revenue bonds, and revenue bonds include single-family first-time home buyers. They include airport and wharf bonds. They also include student loans, and then multifamily. And the area that we're going to be discussing is multifamily. The reason that investors like municipal bonds is because of the tax benefits, its low volatility, and low default risk. Another reason that they like municipal bonds is that in the revenue bond space is that the investors are more keyed into the debt service coverage ratio, and they'll allow higher leverage, like in certain instances, 100% loan to cost for a revenue bond. So that would be pushing off of like a New Jersey Turnpike transaction where the loan to cost or loan to value is not as relevant as the ability to repay. Municipal bonds are generally exempt from federal and in certain cases, state and local taxes. Here's a picture to show you what the makeup is of the municipal bond arena as it pertains to new issuance. And the area that we are looking at are the housing bonds, and they're in the middle section, that grayish green area. But it's a meaningful amount within a $385 million market that is issued each year. The municipal bond arena in total is about $4 trillion, but as this chart states, annually, or at least in 2017, there was about $385 billion issued. And you can see in here, the lion's share of these bonds are for education, which is the blue piece, general purpose, which would be GO, general obligation bonds. This lighter blue is utilities. The pink piece is transportation, so that could be the turnpike authorities. And then the red one would be healthcare, which would include hospitals. And so after those, the housing takes the next biggest slice, which is, again, a pretty big chunk. Tax-exempt bonds are a valuable part of financing. Historically, the interest rates are lower. Interests are paid on tax-exempt bonds are usually exempt from federal and state, as I've already mentioned. They have longer amortization. And when you're talking about revenue bonds, in particular multifamily, if you use tax-exempt bonds, you would be avoiding the 9% credit, which you all probably know under the Low-Income Housing Tax Credit Program, and you get this automatic 4% credit, which we'll talk about a little later on. Private activity bonds are issued by state and local governments, so you could have a development authority be a conduit issuer, or you could use a county, or even in certain instances, the state of. Mike and I are working on a deal with the Kentucky Housing Corporation, which is a state quasi-governmental agency, as a conduit issuer. And what that means by a conduit issuer is that they are purely allowing for their municipal status to be extended for the issuance of the bonds, but they are not taking on any legal or financial risk. So they're just a complete conduit to the transaction. Again, the bond proceeds are used for a defined purpose, and that's usually for a private entity. And these bonds, that when you have a for-profit entity, these are all under private activity bonds, I apologize. When you have a for-profit entity, those bonds are referred to as 142D, and we'll discuss that in greater detail. There's another form of multifamily bond issuance, and those are known as 501c3 not-for-profit. So the first one that I just talked about was for-profit entities. A not-for-profit is something that receives a determination letter from the IRS, and they are deemed a 501c3 charitable entity. They still need a conduit issuer. That could be the state or local development authority. But they enjoy tax-exempt status because the IRS has blessed them. And then finally, the third kind of borrower for utilizing tax-exempt bonds as it pertains to a multifamily property could be a governmental entity, and that would be something like a housing authority. When we're thinking about using tax-exempt bonds for funding multifamily properties, you're going to have to deal with what's called a set-aside requirement. And when you do a set-aside requirement, you have an election of either setting aside at least 20% of the units or more within the project for families that have income of 50% or less of area median income. The area median income is determined by HUD. Or you can elect to do 40% or more of the units within the complex set aside for individuals that have income that don't exceed 60% of area median income. And moving on, the low income, we need to deal with a qualified project period, and this is more detail than we really need to get into, but this is stuff that bond counsel and underwriters counsel will be reviewing, and we just have to make certain that we have a qualified project period. Like it says, it begins with 10% occupancy, and there's a couple of other tests. When you're dealing with a for-profit transaction under what I referred to before as a 142D, you need to get what's called a volume cap from the state. And so each state has private activity volume cap, and they allocate it competitively. But once you have that volume cap under a 142D private activity volume cap for a private developer, they have an as of right to get the 4% credits as long as a project complies. So as you all know, there's a 10-year rule with low-income housing tax credits. So if a project complies with that rule as far as a 10-year rule, then you can utilize the 142D bond program for private developers and get the tax-exempt bonds, and then you automatically get the 4% tax credits, though you still need to fill out the application, and there's a scoring process, and the state has to still award it to you. So you even though you have them as of right, you still have to, I'm sorry, I won't one page too far, you still have to do that application, and they have to deem your project worthy of receiving the low-income housing tax credits. So with a for-profit, you do need to go to the state and ask for volume cap. It's issued selectively. If you have a 501c3, they do not need a volume cap. I would be working with bond counsel to help get the volume cap for each deal. You could go to the conduit issuer and ask them to help you obtain volume cap, or in some instances, you would go directly to the state, or in other instances, you may hire a political liaison to help you get it. But in most states, there's plenty of volume cap available, which allows for-profit developers to use tax-exempt bonds. Again, the not-for-profit 501c3 is exempt from that process. They don't have to get volume cap. And at Housing Authority, they don't need to get it either. There's another aspect to this, and it's called TEFRA, and it's a component that Mike and I kind of had some problems with on this one project. And it is a step where you have to inform the public that you're going to be utilizing tax-exempt bonds. It's called the Tax Equity and Fiscal Responsibility Act, and you put out notice that you're going to use tax-exempt bonds in the paper, and then 14 days later, you go to some public location, and 99 times out of 100, nobody ever shows up, and you breeze right through that process. I'm giving you all these pieces, though they may be more than you really want to see. I'm just trying to give you all the pieces, and we'll ultimately get into case studies so you can see exactly how it all applies and works. So please stick with me. When you're dealing with tax-exempt bonds, there is a 2% cost of issuance rule that you can only use. No more than 2% of the tax-exempt bonds may be directed towards fees, and that would be lawyers' fees, my fees, and whatnot. And anything in excess of that has to be funded with either equity or a taxable piece. There's a rule on the bond maturity, which cannot exceed 120% of the expected economic life of the project. And if you're doing a for-profit deal, 142D, not a 501c3, you need to expend at least 15% of your monies towards rehab. And that the 15%, if you were to acquire an $11 million project and $1 million was deemed to be the value of the land, then you would have $10 million of improvements. You would have to do 15% against the $10 million or $1.5 million. So that's just another consideration to be aware of. There's some disclosure that we need to deal with in the bond process, and much of it's ongoing after closing and during operations. And that's something that we will help put together and make certain that everyone is well aware of it, and that it operates nicely within the project and within the management's setup. Now, who are part of the teams in a tax-exempt bond funding? Well, here's a chart, and of course the borrower is at the center, and we're going to talk about each one of these participants, starting with the issuer at 11 o'clock, and then issuers counsel, bond counsel, credit enhancement counsel, tax credit equity counsel, financial advisor, trustees counsel, rating agency, underwriters counsel, and underwriter. So the issuer, as I've already mentioned, they are a conduit issuer. We aren't using their credit, nor are they legally responsible for it. They can be, again, from the state to an industrial development authority or even a county or a city. Many times they will have counsel, and their counsel will be there to ensure that the issuer is doing what they can do, that they're permitted to do, but also that they aren't taking on any unknown liability, both legally or financially. Many times an issuer will have a financial advisor, and that advisor will review the transaction and protect the issuer again. Bond counsel I would refer to bond counsel as counsel to the transaction. They are hired by the issuer, or sometimes they're hired by the borrower and the underwriter, myself. And again, I probably didn't say that. I would like to be the underwriter in these transactions. And so I would help in coordinating the team, that chart that I showed you above, and all the individuals that I'm going through right here. But they're hired by the issuer or by the underwriter, and they'll opine that the transaction is tax exempt, that the bonds will be tax exempt. Their responsibilities include preparing the indenture, the loan agreement, the TEFR notice, what's called arbitrage certificate. They render opinions, again, that the validity of the bond with respect to statutory authority, constitutionality, and exemption of interest for federal income tax. And they coordinate and prepare the final bond transcript. The underwriter, what I do, I analyze the financing alternatives for the borrower. That would include looking at whether this transaction, a possible transaction, we should get credit enhancement, whether we should get bond insurance, whether we should just use the rating agencies, all of which I'm going to talk about in a little bit. We will develop a financing plan and present it to the borrower, and also you guys working closely with you as brokers. We will manage the credit rating process. We will market and price the bonds, and pricing is just helping establish the coupon. We'll provide final cash flow analysis and arbitrage analysis, and we'll facilitate the closing with DTC. DTC is a Depository Trust Corporation. It's kind of the back clearing office for the bonds, and it allows everyone to receive their coupon payments and their principal payments when they are released from the trustee for the payment of the bonds as kind of the repayment of their investment. Underwriters counsel would be working for me. They would draft the offering documents, which are referred to as a preliminary official statement and the final official statement. They'll also draft the bond purchase agreement, which is the document in which we, Stiefel, would be stating that we're obligated to purchase the bonds and all the terms within that purchase. And they would also draft the continuing disclosure, which is what the borrower will use to put out disclosure data to the world. And we typically use a national repository for these disclosure items. It's called EMMA, and it's available. You can go on the internet and look at any bond transaction and look at the disclosure material for each one of those projects. The borrower, of course, he develops and then owns a project, almost always is a single purpose, single asset entity. As I mentioned before, there's a couple of different structures. They could either be a for-profit corporation, they could be a limited partnership, they could be a not-for-profit 501c3, or they could be like a housing authority, a governmental entity. Borrower's counsel will, of course, be sitting there with the borrower. They'll review all the legal and bond documents on behalf of the borrower and should have experience in real estate matters, in particular for that state, and in bond financing. Credit enhancement would include utilizing a bank, and that could either be a local bank or a national bank. Credit enhancement could include Freddie Mac, Fannie Mae, FHA, Ginnie Mae, and then they'll have counsel. The tax credit equity, I suspect you guys all are fairly aware with that program. The purchases the credits from the borrower in exchange for an equity stake in the property. There are two types of 9%, which when you do the 9% credits, you would not be eligible for tax-exempt bonds. And that program is very competitive. When you go into the state, they have a QAP, and they usually dish out the 9% credits to smaller properties peppered around the state, where when you go to the 4% credits, one of the benefits is that once you get the allocation for the bonds, the 142D bonds, then the state is not concerned about a concentration of low-income housing tax credits for a particular property. So you could have a 150, 250 unit complex that enjoys 4% credits, where you would not be able to get that same kind of treatment if you're under the 9% credits, because they typically like to see smaller projects, 50, 70 units. So one of the kickers in using tax-exempt bonds, again, is that once you get the volume cap, the 142D allocation, then you have an as of right for the 4% credits. Again, you still have to apply with the state, and they have to score it, but you're much closer to getting a larger project utilizing tax credits. And of course, tax credit purchasers are going to have their own counsel. Then we have a trustee. The trustee is just the fiduciary agent that is going to be around post-closing to release monies for rehab needs, release monies back to the borrower pursuant to a budget, because many of these will be a gross revenue pledge, which means that the rental receipts will be captured and swept on a periodic basis by the trustee. And a trustee could be somebody like Wells Fargo or some other bank, but we want to make certain that whoever trustee is somebody who's very familiar with doing this kind of business, not a local bank. And again, they will sweep the local revenue box, and they will hold it and release it in accordance with what we establish as a flow of funds. And one of the things that the borrower is very keyed in on, among others, is that the payment of operations, which is really high in the priority in distribution of the flow of funds, those monies will come out usually monthly, and they're based on a budget. But the trustee is the one who's responsible for collecting the monies and then distributing monies in accordance with the flow of funds. They'll also maintain certain reserve funds, and that could include a covenanted debt service reserve fund for the bondholders. It could include a construction fund and other funds. The trustee will have their own counsel, which isn't, they'll review the transaction and make sure that it works for the trustee. And then we may go to a rating agency, and the major three rating agencies are Standard & Poor's, Moody's, and Fitch. The ratings have a direct impact on the cost of borrowing, so the higher the rating, the lower the interest rate. All right, steps in issuing the bonds. Mike, maybe I'll stop for a second. Is there anybody that has questions up until this point? Because I'm now going to get in, as it pertains to what bonds are or who is a participant. And if not, I'll just give it a couple of seconds and I'll move into steps into issuing a bond.
There are several questions, and they're all kind of the same question, really, and they involve the broker's role, and I'll kind of summarize them all together. But basically, it's kind of the same experience that I had. And it comes to, this is pretty complicated stuff that, the people who are asking the questions, it's new to them. What is the broker, the real estate broker's role in any of this? Do they need to be experts at this stuff before they try to represent a deal that's going this direction? Or can they be like me, Jim, and be ignorant of it all and kind of just look to somebody like you to marshal the process?
And it's the latter. I mean, you're going to be surrounded by talent throughout, and you should continue to do exactly what you do. The purpose of this is to show you guys another funding mechanism, which, if we could do a transaction that is fully levered, and let's assume that we're going to do a deal that for a not-for-profit, and we're going to use a rating agency, which we're going to get into this model in a second, and it's fully levered, so it's 100% debt financed, and the interest rate is 5%, but we have certain reserves, like a covenanted debt service reserve. We have other transactional expense. We can do a fully levered transaction where, if the cap rate is a 7.25 or north of a 7, we can make that deal work and go through the rating agencies and have a successful funding. So typically a B- property, or maybe a B, but once you get into the B+ or the A's, it's not going to really work. With those kind of projects, we can work with you guys and use this funding approach to have a favorable funding. But the purchasing power in doing that is pretty high, because there's no needed cash-on-cash return, and so we get to utilize all the revenue directed towards the payment of the bonds. And I'll show you guys a math on that. But to answer your question specifically, Mike, you guys should just be aware that this funding mechanism is out there. And if you have a borrower who is looking at a project and it's again a B minus property or something like that, and it has a pretty juicy cap rate, then this is a method that is well worth reviewing and seeing if it works for you guys. So you just need to know globally that, and then present it to your borrowers, and I'll come in and again make my own pitch and share with them how it works. And if the borrowers feel that it's compelling and it solves some of their problems, then they'll utilize it. And I'll be adding value in the transaction, as of course you guys already are adding value, and we'll fall into the municipal bond funding approach and surround ourselves with the talent that I showed you already of the team of professionals that are working on these transactions. So hopefully, Mike, that answered the question.
Yeah, and it kind of naturally goes into the next question, which is how does a broker take a traditional multifamily buyer, and can they be turned in? Can they form a 501c3 and become a bond financed buyer, or do they have to be in that business already set up that way?
That's a great question. So there's two parts to that question. I'll get to the C3 part second. If you have an owner who owns a property and they're trying to sell it, and then they say, why don't I just refinance with tax-exempt bonds? I see that as a better funding source, and if they're going to do 100% leverage or a higher leverage, I can cash out, and that's all I really want. The municipal bond arena is not designed to be used as a refinancing mechanism. So you would have had to have received what's called TEFRA, which I already talked about, which you get before you start the funding process and expenditures of monies. And that allows for all expenses from that point forward to be qualified expenses. If you have expenses prior to TEFRA, then they're all not qualified expenses. So if a developer has a project, it's RMI, and they already have a loan, and they said, I want to refinance, well, they probably never got TEFRA, and therefore all of their expenses don't qualify. They can't utilize a tax-exempt bond arena because it would be deemed as bad money. If they happen to, which is unusual, happen to have gotten TEFRA, and even if they got their own funding source for a month, a year, 3 or 4 years, and they kept TEFRA valid, which is just a small legal problem, you just have to reactivate it with the issuer, then that money, that interim money, if they did that process and they didn't use tax-exempt bonds, rather they just did TEFRA and they used some other funding source, even their own cash, and then 3 or 4 or 5 years later they decided that they wanted to use the municipal bond arena, that would qualify because they TEFRA'd and they kept it valid, because it would be viewed that interim money was bridge money. But you can't just decide, a developer, I want to use municipal bonds to refinance me, because it doesn't work that way. Now, if a developer wants to use a 501c3 as a legal entity in pursuing properties, that would be fine, and they could develop their own 501c3, which costs less than $10,000, and they get a lot of benefit out of doing it. But there's also another side to that, which is that when you do a 501c3 transaction, there shall be no private inurement. So that means that the for-profit developer, they can have this not-for-profit 501c3 that is near them, but most likely they don't want to be on the board. They want to have some of their community do-gooder citizens on that board, and they work as the manager for that 501c3. They work as the developer, the asset manager, and they earn a fee, but nobody shall earn an equitable interest in the property if it's held by a not-for-profit. And that's always a challenging thing for a for-profit developer, because they look at that and say, well, wait a second, why would I do this? Well, if it's a fully levered deal, then then it's, the alternative is for the for-profit developer to go to a bank and get a 65% loan to cost loan or something like that, maybe 75%. And in certain instances, they have to do recourse, or they can do a fully levered deal, not utilize their own equity, do a 501c3, get a management fee, get a developer fee, maybe get an asset management fee, and move on, and then build this other group that can go out and start generating monies and have the ability to go and pursue other assets, which ultimately will just come close to them, where they will beef up their management, they'll beef up other parts of their enterprise by having this not-for-profit 501c3 grow. So I don't want anyone to think that having a 501c3, they can simply just rate it, because that would cause a lot of problems with the IRS, and nobody would want to do that. So you just have to be careful how you construct the 501c3s. If you want to, there are C3s that are out there that can be acquired for the legal cost of setting them up, and we can bring them in for a transaction right at the beginning, or they can do their own. So that's a long answer to your question, Mike.
Okay, great. There are some other
Anything
questions,
else?
but go ahead, and we'll get to them towards the end.
Okay, all right, steps to issuing bonds. So here we're just going to quickly go through the timeline and the things that we have to do. You have a kickoff call with a borrower, and we'll establish a financing table. We'll analyze the structure. We'll do the inducement resolution, which really is the that and TEFRA, but the inducement resolution is the thing that I said. I refer to it as TEFRA, and I try to do them at the same time. I apologize. But the inducement resolution allows for any expenditure from that point forward to be qualified as good expenditures. So if you once you do that, and even if you get a bridge loan from that point going forward, then all the monies can be later refinanced with tax-exempt bonds. The next week 3 and 4, we do a bond structure. We refine it, which is really just a bond model. We have the TEFRA notice posted, which is just notifying the public that we're going to use tax-exempt bonds. And again, 99 times out of 100, nothing ever it happens and nobody shows up. We do the first draft of the documents. We start working with the rating agency. 5 and 6, we do the preliminary official statement, which is the offer memorandum. We start talking about the due diligence, and we comment on the bond documents. And then week 7 and 8, we do TEFRA. We start preparing the rating agency cash flow, and we comment on the offer memorandum. 9 and 10, we draft the final draft of the bond documents are circulated. The bond resolution, which goes to that conduit issuer, takes place. We have conference calls with the rating agency. Week 11 and 12, we draft the final offer memorandum. We receive rating from the rating agency. All fees and expenses are due so that I can crank it into the bond model and make certain that I'm capturing everything. We post or distribute the offer memorandum to the potential bond buyers. Then we come up with a pricing date and price of bonds, which is setting the coupon. We circulate the final bond model and the debt service coverage ratio in week 13 and 14. And then we go to a pre-closing where all documents are signed and opinions are rendered. And week 15, we post the final offering document. And then the 17 and 18, we finalize price and close. So that's essentially the timeline of what occurs. Now I just want to give you some market activity. So this is the 30-year municipal market data AAA curve. And you can see that back in January of 2014, it was nearly at 425. And now it is just about 3%. So it's relatively low, but we're going to also give you a couple more charts. So this is going back to 93. And in 93, you can see that MMD, the municipal market data, is a blue line, and it was just about north of 6%. And today, or actually when I did this, it is now at 2.72%. So it has come down substantially, but it has enjoyed a pretty relatively narrow band in fluctuation. And the average over this period of time, as you can see for the 30-year municipal market data curve, is a 4.53%, and Treasury is 4.27. Okay, so now we're going to talk about some of the credit enhancements. Freddie and Fannie. Freddie and Fannie, through their approval lending, continue to play a major role. Both Freddie and Fannie provide credit enhancement and, in many cases, liquidity support. They function like a direct pay letter of credit, like a bank. They have different maturities that they'll look at. They'll look at a 15-year. They can look at an 18-year. I'm sorry about that. Both Freddie and Fannie have curtailed their variable rate. They just don't like having variable rate debt out there because it's just an unknown, and they try to hedge that, but they just forever are trying to get rid of that. Freddie has a new program where it actually purchases these tax-exempt bonds directly. Now we're getting into the case study, and here's our first property. This one, the problems with this particular property is that the properties that there are a smaller number of units or a relatively low value, difficult to finance with the 4% credits and tax-exempt bonds because of the high fixed cost. The tax credit syndicators usually do not have interest in a small investment size. They want to make certain that it's a larger critical mass. So what we did was we pooled a bunch of properties together. And in this instance, you get to spread the legal costs and other fixed costs over the entire transaction. By creating a pool of smaller properties, the size of the equity investment is significant and attracts investors. And the loan structure is one mortgage as opposed to 9 separate mortgages. Here's what we did in Wisconsin. 9 different properties, a total of 573 units. We have some Section 8 in here, and we had a construction period of 9 months. With that, we had the developer is Wisconsin Housing Preservation Corp. We had a tax credit syndicator, Boston Capital. The Fannie Mae, to get to Fannie Mae or to utilize them, we had a U.S. lender, designated underwriting services lender of Centerline. The issuer in this instance is Public Finance Authority, and they are a multi-jurisdictional conduit issuer out of Wisconsin. The bond counsel was Walker Jones, underwriters counselor was Sidley, and we had an issuer's counselor, Eichner Norris. The maturity date was 3 years, so this was back when they would do the shorter maturities, and you would have to, it was more or less like a liquidity support and more or less like a bank letter of credit, and there was a tender of 1 year. We got a rating on this one of A1 plus, and the interest rate, because it basically is a low floater, was 35 basis points when we issued it. And a low floater is where it resets periodically, and in many instances they're reset weekly. So you get to enjoy essentially an interest rate of whatever a week, the risk of a week is, and you know, the risk-reward relationship in a yield horizon or a yield curve. And so that only exists because you have a liquidity support fund. In this instance, you have Fannie Mae, and was this Fannie or Freddie? This was Fannie. And so we had Fannie Mae in there as a liquidity support fund. So at the end of the week, if the investors didn't like what they were getting, then they could put the bonds back to the investor, and the investor would be obligated, the underwriter, and the underwriter would be obligated to reset the rate. And if we failed to reset the rate, then we had Fannie Mae there that would be a backstop to make certain that the investors got their money back. And that's why it was only 35 basis points, which is really low, of course. And then here's a look at the sources and uses. We have the Fannie Mae loan of $20 million. We have a bridge loan of $460. We have the low-income housing tax credits of $11 million. We have another related parties loan of $11 million. We have funds from operation of $1 million coming in. So this is we give credit for monies from operation from. This is a refinancing of another project. And then there is an existing repair and replacement and insurance escrow from a prior deal of $163,000. And then we had an equity bridge loan of $5 million. And you can go through and see where the monies went. But in this instance, $27 million was a purchase and $9 million was a rehab. And it just goes right down. So they had to do at least 15% rehab, and they clearly satisfied that requirement with the $9 million. We can also look at a HUD program, and in HUD, there's various programs where if you're going to do construction or substantial rehabilitation, we can use 221D4. If it's an acquisition refinancing, 223F. If it's a refinancing of an existing FHA loan, we can use 223A. And if it's healthcare, it's 232. The HUD is great. They have very low cost of capital, but it takes a long time to get through FHA. And so that's why people will avoid this. So if you can get through this process, it's probably one of the better funding sources for this kind of project, but it just takes forever and you have to go fit exactly within their box. Now we're going to show you an FHA program. In this one, given this rent restrictions, there wasn't enough cash, and the 9% credits provided the largest equity for the low income, but there was a limited amount of 9% credits, which we've already talked about. The solution was to use 4% credits to finance the project, and the 4% credits combined with the HUD 221D4 provided most, but not all of the leverage and equity necessary to develop. There is a source for soft monies, basically gap monies, and we'll see that in the sources and uses. So in this instance, they receive the 4% credits, but you have to at least have this called the 51% rule, where the tax-exempt bonds need to be used to fund at least 51% of the development. And we can talk about that later during the sources and uses. And then in today's credit, the long-term conventional FHA charges lower than tax-exempt bonds secured by Ginnie Mae. So the FHA program is going to be one of the best interest rate programs that you can get. Oh, sorry, I didn't mean to move that. Significantly reduces negative arbitrage, achieves the lowest cost in borrowing, and meets the requirements for the 4% credit. So the project that we're looking at here is a Baton Rouge project north of downtown Baton Rouge, 144 units, 100% restriction on rents at 60% AMI, and it was to be built, 15-month construction period. Here's the development team. And then here's a layout of the project, and it had an optional payment that they could get out in 12 months. Again, it was a low floater program, and when it came, it was at 70 basis points. Now, in this instance, you'll see that we have $8 million of tax-exempt bonds, but we have $19 million worth of total uses. And there's a 51% rule that you have to have at least half of the $19 million, which would be 18.5. So it qualifies. I'm just doing the math right now in front of you. So you have to have at least half of the $19 million has to be funded with tax-exempt bonds. And when you go down to the construction cost or some of this value, you get to strip out the value of the land when you do that. And so the value of the land in this instance would be about $500,000. So once you strip out $500,000, then you're going to have no problem meeting the 51% rule, or just greater than 50%. But in this instance, again, we used FHA loan for $8 million. We used a home loan for $700,000. We used another home loan. We used a grant. Then we had a redevelopment loan. So you can just see that it was a collection of a lot of different sources to make this project work. Then finally, there's a Standard & Poor's program, which this is most of the time the easiest, and you're granted a lot of structuring latitude. You aren't contained within the box of FHA or Fannie Mae, and you can many times get high purchasing power because you have a high leverage. So in this instance, they'll accept a transaction at 125 to 135 debt service coverage ratio. They will look at the historical trends on the vacancies. They'll cap the occupancy at 95%, seniors 97%. They will accept the certain savings that you may incur, but it must be validated. The repair and replacement, at a minimum, they're going to want $300 per unit per year. And depending on the state statute, they will allow for the underwriting of property tax abatement. In this instance, we don't have any credit enhancement or mortgage insurance, no equity required. On a 35-year interest, could be a 475. We will have a 10-year optional call that is held by the borrower, not held by the lender, on a 35-year amortization. In today's environment, we can get that a little lower. Maybe we can go down to 8 or 7 year optional call held by the borrower. Closing typically should be 75 to 90 days. There are no loan-to-value constraints. It's non-recourse, and the bonds are priced off of the municipal market data, which we looked at before. So here's another property, actually 5 properties, S&P pool. The problem here is, what is the best financing structure for 501c3 to maximize the proceeds for the acquisition, and how do you finance multiple small properties? The solution was to cross-collateralize a pool financing of a 501c3 to issue the bonds through an issuer such as Public Finance Authority, which is a multi-jurisdictional issuer. In this instance, we had properties located in both Iowa and Missouri, 5 properties, 349 units. They were all Section 8, have contracts. Here's the key participant list. In this instance, we had a 35-year maturity. We had a 10-year par call. The bonds were A-rated. We did, because we have that good money and bad money, well, you only have 2% cost of issuance limitation, and anything in excess of that has to be funded with either taxable bonds or equity. So in this instance, because we're doing 100% debt financing, we had to issue taxable bonds to deal with monies in excess of the 2% cost of issuance limitation. And then the rest of the bonds were tax exempt, and the maturity for those were 10 years, 25 years, and 35 years. The average interest rate was 4.88%, and the issue size was 16.96. This is what it looked like. We did the senior loan, which was the 10 years, the 25 years, and 35 years is $15,170,000. We did an original issue discount, which is an OID, and that's just for structuring purposes. So the bond buyers receive the bonds at a slight discount, and we have to carry that properly, and that discount value was $339,000. And then we did a taxable piece which was the 8-year piece for $1,790,000, which is the amount that was in excess of the 2% cost of issuance. And that is because of legal counsel fees, my fees, anything again in excess of 2%. It's very unique, very specific. What real estate brokers' fees are not part of the bad money number. The money's in excess of 2%. That would be real estate related. Its financing costs in excess of 2% would be over here, be in the 1.79 million. Also, any kind of working capital or operating reserve would also hit the bad money and had to be carried in part in the 1.79 million. So we had an acquisition price of $13.9 million. We had a debt service reserve fund, which is this covenanted reserve fund of $514,000. It was 6 months. We had an operating reserve fund. This is bad money of $120,000. We had insurance premium. This is another bad use of proceeds. So these things all go against that 2%, and that's $138,000. We had certain repairs. This is good expenditure, $352,000, and the $50,000 are good. The replacement reserve of $149,000, that can be bad money. Real estate costs, that should be good expenditures, but the $252,000 and the $338,000 again are bad uses. And so this is the total cost, but that's kind of how the program works. Then we ultimately also have a private placement where we can just work with particular investors and sell the bonds directly to them. That's a very negotiated process and a structured transaction. There's no credit enhancement, no mortgage insurance. We could do a 40-year interest at a 5.75. We can have a mandatory tender in 16 years. The debt service coverage ratio can be lower. Loan to value, all of this is negotiable, but it has to do with what the specific investor wants. In certain instances, the sponsor will provide specific guarantees, and many times that is construction completion and something like that. We can do new construction private placement and also non-rated, but we'll get into new construction private placement quickly. There's a shortage on affordable housing in certain fast-growing markets, limited availability of the 9% credits, and land and construction contracts may require a quick close. Solution: work with the local government to identify any concerns, use 4% credits with soft money, and structure a private placement. So in this instance, we did a deal in Texas. It was new construction, 300 units. And this is a rendering. Here's the team participants. I'll give you a second to look at that. And this is the structure. Is a 40-year, 17-year mandatory tender, 15-year put. It was non-rated, and we based it off of an index that we use, plus 235 basis points during the first 18 months, and then 505. This is what the sources and uses look like. Tax-exempt bonds, senior. Then we had a tax-exempt bond sub. We had home funds, low-income housing tax credit, and a deferred developer fee. And this is the uses of the proceeds. And you can see the construction cost was $25 million. The benefit here is that we use bond proceeds for the construction and then ultimately the operation. So the developer does not have to go out and look for a loan immediately upon completion. They know what their deal is going in. It's locked in. And many times that gives investors a lot of comfort, in particular in a rising interest rate environment. And that's mostly it. I hit it all, and I'm going to leave my screen. Oh, I can go back. But Mike, I'll open it up to you for questions.
Okay, great. Appreciate it. And again, everybody, there's some questions in here. So I'll keep submitting yours as we're talking here. Jim, one says, do these projects have to be, is there locational sensitivity to these? Do they need to be in areas near hospitals, schools, bus lines, grocery stores, or any of those kind of constraints with them?
That's another great question. And the answer is, I mean, if it's an existing property, then we're going to be pushing off the cash flow. So they can be in the middle of nowhere as long as they have historical occupancy and financial data. They don't necessarily need to be in any one particular place. To use tax-exempt bonds, they need to be inside the 50 states of the United States. But no, they can be anywhere, and we just will rely on the historical numbers to gauge whether it has the ability to cover the debt service. If it's a new to-be-built property, then in that instance, we're going to have to do market studies and feasibility studies, and we're going to have to check out the demographics and competition and the economic viability of the community, and then also ultimately the construction costs. So whether it's a union community or state, and whether there's other constraints that may exist with a particular community in construction would also come into it. But that's all part of new construction. Okay.
Is there a limit on the developer fee, and what is the difference between deferred and non-deferred developer fees?
So typically we look at developer fee at around 5%. When it gets up to 7%, it's pretty high. The developer fee, the bond buyers, it's a funny money number. So the bond buyers don't want to see the developer get paid a lot of money up front, because then it ends up that the developer is getting paid to close the transaction and the project hasn't advanced any money in the repayment of the debt. So the developer is getting paid ahead of the bond buyers. I have a problem in new developments in paying the developers anything greater than $800,000. In an existing property, I would say it's at that or lower, but I would say that the upper limits of what we can pay at closing, and this all depends on the size of the project. If it's a $7 million deal, paying $800,000 at closing would be a bit extreme. But assuming it's a $25, $30 million project, paying a developer $800,000 at closing is acceptable, and then the balance of it would be a deferred developer fee, and that would be paid out of operations, out of cash flow from the property. So the difference between a developer fee and a deferred developer fee is one's paid at closing, and the other is paid through operations. But I would say it should not, in total, they shouldn't exceed. We should target no greater than 5% and no more than $800,000 at closing.
Okay. Arno in Las Vegas says, I'm still not very clear on the 4% and 9% credit. Can you talk a little bit more, differentiate that, explain what those are?
Sure. The 4% credits, when you go in and ask for the 4% credits, the state has a qualified action plan, and that's put out in each state each year. And what they try to do is they say, okay, we're going to have applications for these 9% credits. We want to pepper the state with these properties. So let the applications come in, let the best applications win the approval and the awards for the 9% credits, but let's minimize the unit count so that we can get it all over the states. So they'll look at 50 and 60 units as the largest unit count for any one location, so they can kind of hit the whole state and make their presence be known. In the 4%, that is kind of an afterthought. You first first you identify a property that satisfies a 10-year rule. And the same goes for the 9%, but unless it's new construction, which then it's exempt from the 10-year rule. So you first identify a property that satisfies a 10-year rule, and then you go in and seek volume cap under 142D, private activity volume cap. Once you receive that, then you have the as of right to get the 4% credits. You have to submit a application, and that application is scored. And as long as you get the appropriate scoring, then you'll receive the 4% credits. The state wants to give you those 4% credits because they want to see your project come online. So they'll do their best to help you score the appropriate number. But again, it's as of right, you get it. It's not as competitive. In fact, it's not really competitive. You just have to get your application in order so that it gets a proper scoring, and then you'll receive it. You aren't competing with everyone like you are on the 9% to get it. The only competition is asking the state for the private activity volume cap for the bonds. And so again, if you're looking for a $25 million bond for a 250 unit complex in X community, if you get the $25 million award for the bonds, then you have the as of right to get the 4% credits. Now you have to put in the application for the 4% credits and have the state score it. And they'll work with you to make certain that you structure it in a way so that you get the right score.
Okay.
Now, and let me also say, maybe some people don't know that, you know, the 9% credits, as you probably all know, work so that you get 9% per year for a total of 10 years in economic value, depending on how much of the units you do a set aside. But let's say it's 100%. So in theory, you get 90% of the total project cost back in tax credit value over 10 years, 9% times 10. And then you can sell that up front. And let's say you can sell that at 90 cents on the dollar. So you get 81% of your development costs back at closing to as part of your capital stack under the 9% tax credits. Under the 4%, the rule is kind of the same, except for it's 4. So you get 4% times 10 or 40%, and then you can sell it for maybe 90%. So you get 36% of your development cost you could have up front. And so that's why you need to have another funding source, and tax exempt bonds are part of that. You actually need tax exempt bonds to even get to the 4%, but that is the model. And the reason the government doesn't allow for 9% in tax exempt bonds is they feel that they're giving too much. They're extending themselves too much, and they feel that it's more appropriate to decrease the credit amount if you're going to use tax exempt bonds, which again, when they do that, they do not get to enjoy taxing the interest income that the investors earn off of that investment. So that's why they reduce the LIHTC value to 4%.
All right, it's 1 o'clock in the east. I like to end these on time, but Jim Cole, I've got your microphone open. You had a question that was a little bit long, so I'll let you ask it, and this will be the last question. Then we'll let everybody go.
Yeah, Jim, the question I had was, I've got a project I'm working on. It's an LIHTC project, and what I was wanting to know is on the 4% tax credit, can you use that 4% tax credit as your equity in the project in advance of having to put any cash in? In other words, do you have to put the cash in first and then sell your tax credits to remove the cash back out? Or, I mean,
I get your question. Yeah, I get your question. So the answer to your question is certain investors will want to delay contributing their money in the LIHTC program. And so what we're going to want at closing is we're going to want to have a deal that works. And so you're either going to have to bridge it or the project doesn't need it. Actually there's three ways. Either A, the tax credit investor comes in, and whatever comes in at closing is the way that we're going to model it, and we're going to sell it, and we're going to show the debt service coverage ratio. B, that whatever they don't bring in, we bridge that amount, or C, the project doesn't need it. So that we are not going to look to a future contribution to solve something. We aren't going to look for that to pay down debt, or we aren't going to look for that to finish off the construction account or the rehab account. At closing, we're going to have the whole deal nailed down, and if that event takes place, that's great, but we are going to model with what we have at the day of closing that those monies available to us.
Okay, that makes sense. All right.
All right. Well, listen, Jim's contact information, everything is there on the screen. You got his phone number. If I could say anything about Jim, I'll tell you this, that for whatever it's worth, in my 35 years in commercial real estate, I've never met anybody who is more tenacious and hardworking and persistent and consistent and doggedly working to try to make a deal happen than Jim. So, beyond the fact that he's a subject matter expert in all this stuff, has lots of experience in this stuff, you won't find anybody harder working for the deal. So, Jim, is there anything else you want to say before we let you go?
Just thank you very much. I would welcome an opportunity working with all of you guys. I enjoy this group a lot, and I think that this is a great tool for you guys to use. So again, Mike, thank you for those kind words, and thank you for the opportunity to present myself and my firm.
All right, thank you. And answer one of the questions. Yes, Jim's PowerPoint presentation is in commercial resource in the document section. You'll find in the network documents area for the convention. So all of that is there for you. So thanks a lot, everybody. Appreciate you taking time out of, I always call this A time in the middle of the day, but this is important stuff with good information. And again, Jim, thanks for your time and your expertise.
Thank you all.